now we're going to talk about accounting assumptions. All right, so that's the accounting assumptions. So the things that people take for granted when they're looking at financial statements, but you should definitely keep in mind, especially if you're new to accounting. And there's only two of them. Okay, we're going to record, well, let's say identify, record, and communicate things of monetary value. Okay, so there's a monetary unit assumption in play here. And what that basically means is that you're only going to include transactional data that can be expressed in terms of money. Okay, so if you have an asset and you can't value that asset monetarily, like you don't know how much it's worth in terms of dollars or euros or whatever you'd like to choose, then you're most likely not going to include it in your financial statements. An example, you own a store. It's a lovely store. A lot of people come into the store. You're not going to include in your financial statements that 3 customers came and stared at your store and they were just amazed at how, you've done such a great job decorating. It has to have a monetary value to it. If they buy something, that's revenue. If you use that money and, invest it in something, that has monetary value because you can track where the money is going. Okay, so if it has a dollar footprint, probably, definitely going to include it in your financial statements. And next, what we're just going to take for granted is that you understand that there's an economic relevance to your business in whatever you include in your financial statements. So we're all people. You can own a business, but that doesn't mean you stop being a person. If your company makes $10 and you decide to take that $10 to, buy the cheapest thing that $10 can buy just for you to consume for your personal enjoyment, you don't get to include that in your financial statements except as a dividend that you've paid out to yourself. Whatever you did no longer participates in the success of your company, except that you've decided to separate that amount of money from your company. All right, and that's just a dividend. Money within my company that's trapped within my company escapes when you start rewarding stockholders. And if you are a sole proprietor, you're the only person that actually owns the business and the only person that is entitled to actually claiming benefits from the business whenever it's actually accumulated some wealth. If you decide you want to start using that wealth for your own personal gain, you don't get to detail what you're doing with that money in your financial statements. It has to have economic relevance to your company. Very, very important. Monetary value, and it has to have some economic relevance to your company. Those are 2 assumptions that we make when we start thinking about accounting. It has to have a monetary value. There has to be a dollar value to it. And at the same time, it has to pertain specifically to your company. Your best friend all of a sudden buys a car, it has nothing to do with your company. Do not include it. Your mom's asking for a bunch of money, it has nothing to do with your company. Do not include it. Those are the assumptions.